I tried every single trading strategy you can think of, be it support and resistance levels or voodoo candlestick patterns or even stupid indicators. And I found that none of them works. And there's only one thing that actually works for me, and it works really, really well and made me a lot of money, and that one thing is called order blocks. This is really the secret sauce that's allowed me to follow the smart money footprints. Don't worry, I'm not gonna charge you $997, I'm gonna give it to you for completely free. So firstly, what are order blocks? Order blocks are basically areas on price chart where large market participants like banks and financial institutions place a substantial amount of buy or sell orders. That is why they are called order blocks. It's literally in the name, guys. Now, order blocks and supply and demand zones, they are very similar with just a few differences. The first difference is that order blocks are much more effective than supply and demand zones. Because after all, the point of order blocks is to really show us where smart money has entered into the market and where they are most likely going to enter again. The second difference is different rules are used when identifying valid order blocks. Now, for a zone to be considered as an order block, it needs to meet 4 criteria, which I'm going to show you later. Now, the trick to identifying order blocks is to look for sharp and substantial upward movement or downward movement. So in this case, you can see we got a sharp and substantial upward movement right here where price is going up very aggressively, just like this. In that case, you just want to look for the candle right before this sharp and substantial upward movement. And damn, that's a mouthful. So this is the candle right here. So in this case, you just need to draw a box marking the top, the high, and the low of this particular candle, and this creates your order block. And then in a bearish scenario, you should be looking for a sharp and substantial downward movement. And once again, you look for the last candle, which created this sharp downward movement, this aggressively down move, if that's even a word. And you just find the candle right there. And that is where you basically drop the order block. It's really not rocket science, guys. It's just you look for that one little candle before a sharp and substantial movement, and you just draw a box marking the high and the low of that pivot candle, and there you have your little beautiful order block. Like I mentioned just now, in order for a zone to be considered as an order block, it needs to meet 4 criteria. Right? It must meet every single one of these 4 criteria. If it does not meet a single one of them, it is not an order block. It could just be like a normal supply and demand zone. So the first rule is that the pivot candle must close below or above the previous candle. So after identifying a sharp and substantial upward movement just like this, we are able to identify that this is actually the pivot candle where we can actually draw the order block. Now, knowing that this is the pivot candle, you need to ensure that this pivot candle closes below the previous candle, because this indicates that institutional buyers are stepping in, absorbing sell orders and preparing to push price higher. So looking at these 2 examples that we have right here, this pivot candle did close below the last candle. But this pivot candle did not manage to close below the previous candle, since this previous candle went all the way down here. Right, so this pivot candle actually closed up here, so it's not really considered as a valid order block in this case. The second criteria is that the order block must cause imbalance. What that means is that there must be a gap. How do you know there's a gap there? You basically look at the high of the pivot candle, and then you look at the low of the next candle, in this case right here, and you can see this creates like a little gap that we have right here. What this gap tells us is that at this point of time, smart money have entered into the market, and it has managed to push price aggressively up so much that it left a gap behind, telling us there was a large amount of demand stepping into the market at this point of time. And then in this example right here, there was actually no gap, because if you look at the high of this pivot candle and then you look at the low of the next candle, in this case, it's pretty much at the exact same price, right? So since there is no gap right here, this order block cannot be considered as valid, therefore making it an invalid order block. The third criteria is that an order block must be unmitigated. It must be fresh. That means price cannot actually tap into it. If it tap into it, then it has already been mitigated. And what this means is that the orders yet to be filled within this order block itself, it has already been filled by the smart money. You must understand why an order block is formed. At this point of time, this is where smart money have entered for a large amount of buy orders, right? So knowing this creates an order block. This means that at some point of time, price is most likely going to come back into this order block, right? Fill up the remaining buy orders yet to be filled before going up even further. Now, in this case, since it has already been mitigated by this particular candle right here, what this tells us is that the orders yet to be filled within this order block has been filled by the smart money, right? So right now, price is most likely going to go up there and is very less likely going to come down and mitigate it. However, there is still a chance that price could come down here and mitigate it in the future, but it's just less likely since it has already been mitigated. The strongest order blocks are always those that is fresh, new, and unmitigated. The fourth criteria is that it must lead to a break of structure. So in this case, this order block right here, it led to this break of structure, making this a valid order block. And then this one right here led to this break of structure, making this a valid order block. And then this one led to this market shift. Once again, is also a break of structure, but it's just like a reversal in the structure and making this still a valid order block. And then this is also going to be a valid order block because it did lead to a break of structure. So those are the 4 rules of order blocks, right? You must ensure that the point of interest or the zone must meet all 4 of these criteria for it to actually be considered as a real order block. If it does not meet a single one of them, it is not an order block. It could just be a supply and demand zone or just an ordinary stupid zone that is not going to work. So now let's apply what we have learned and really learn how to differentiate between valid order blocks and invalid order blocks. So this order block right here, right, we saw that there was a sharp and substantial upward movement. Cool. And then we know that this is the pivot candle that led to this movement. And did this pivot candle actually close below the previous candlestick low? Yes, it did. Cool. Is this unmitigated? Yes, it is, right? And was there some form of gap? Yes, there is. There's a gap between the high of this candle and the low of the next candle. Okay, cool. There is unmitigated, it caused imbalance, there is a gap, and it closed below the previous candlestick low. And it led to a break of structure. That's the last criteria. It did, right? It did lead to a break of structure. In this case, this tells us that this is a valid order block. So we can expect price to come down here at some point of time, mitigate it before going up even further. And then let's look at this next zone right here. Do we have a sharp and substantial upward movement? Yes, we do, right? But look at this pivot candle. This pivot candle did not close below the previous candlestick low, which is right down here. In this case, this is an invalid order block. And then let's look at this next zone right here. In this case, sharp and substantial upward movement, but the thing is there is no gap, all right? You can see there is no gap. This is the high of this pivot candle and the low is like all the way down here. There is no gap. That is why there is no imbalance whatsoever, and this zone has also been mitigated, right? Which means smart money have already used this zone. In that case, we can just ignore about this zone right here. And then the last zone that we have right here, okay, sharp and substantial upward movement, cool. Is it unmitigated? Yes, it is. Did it cause imbalance? Yes, there's a small little gap right here. The marker that I'm drawing right here is way too big, but yes, there's a little bit of gap right there. And then this did close below the last candlestick low, making this a valid order block. So then now that you understood theory, let's go on to the charts and apply what we have learned so far and really ensure that you get a deep understanding of the order blocks before you actually go and apply it onto your real account with your hard-earned money. Now, how do you actually trade order blocks? Where do you enter and where do you exit? That's what we're going to cover next, right? I'm going to show you my entire order block strategy from top to bottom. First thing you must understand is that there are 2 ways to actually enter for a trade using this order block strategy. The first way is called a risk entry method, and then the second way is called the confirmation entry method. I'm going to show you the pros and cons of each, and then based on this, you can decide which works best for you and then pick that one, right? So firstly, let's talk about the risk entry method. So based on what we have right here, let me just identify the order blocks. There's perhaps one like right here. You can see there's a large amount of imbalance right here, and then there is a gap, it's unmitigated, blah blah blah. We know that, okay, cool, there is an order block right there, okay, and then this is the pivot candle that caused this sharp and substantial downward movement. And since prices already came all the way down here, yes, there is still a chance that price could potentially move up there, mitigate it, and then go down even further. But let's look at what we have right here, because we have another order block. Right, so there is another order block right there, because once again, there is your sharp and substantial downward movement. Okay, that is your gap, and then this also led to a break of structure to the downside that we have right here, where price, I don't know why I just said that, where price has just broke past the last swing low, right? So that is your bearish break of structure to the downside. Okay, so now you can see we got these 2 order blocks right here. The question you guys are gonna ask me is, okay, cool, Brad, which order block is price gonna go? I have no idea, alright? I don't have a crystal ball. I'm not a fortune teller. I have no idea. Okay, so if you are using the risk entry method, that means you are most likely going to be placing a sell order at the edge of the zone itself. That means when price eventually go up there, touches the zone, you'll be tapped into a sell position automatically by your broker, and then you are praying for the best, right? You're praying that, price will not hit your stop loss and price will just go in your way. You're praying that this order block will work. So that's the risk entry method. All right, basically placing a sell or buy limit order at the zone itself, and then once price step into the zone, your broker get you into the trade. The bad thing about this risk entry method is that you don't have extra confirmation, right? That means sometimes price can just blow right past your order block. In that case, you have lost this trade right here because you didn't actually wait for confirmation. Okay, but we are talking about that later. For now, let's say you actually decided to go for a risk entry method and you place your sell order at the edge of this order block right here, and you place your stop loss above the order block itself. And then for a take profit, you can place your take profit at the next structure, be it the next swing low, right? You always look towards the left. So if I look towards the left right here, I'll see that based on the structure, this is the last swing low that we have right here, because this is the last time price actually pull back all the way down here and then goes all the way up there and break structure right there. So this is the last swing low. So you can potentially target that last swing low that we have right there. Or you can even target the opposing order block, right? The next order block, which could potentially be this area right here. This is the next order block, right? So all in all, both of these look exactly the same. So let's say you decide to go for a risk entry right there. Let's see how this play out. Okay, cool. Right here, you got tap into the trade. Let's just continue to see what price does. Okay, you can see supply stand to the market and bam, you hit take profit. Congratulations. Now here comes the brokies. Oh, Brad, you could have just cherry picked this. Like this is like a perfect zone. You just bar replay. Anybody can do it in bar replay. I agree with you. That is why I don't really like to use this risk entry, because for every one order block that actually works, there is like 5 other order blocks that don't actually work. That's just the nature of the irrational and unpredictable market. Before I show you the next method, let me just show you more examples on this risk entry method. So let's look at what happens next. Okay, price just blow right past that, and then we are looking for our new order block. Okay, price has stepped into this new little, okay, this is not really order block, this is more of like a supply zone because it did not meet all 4 of these criteria, right? There was no gap. It's also been mitigated whatsoever. So this is just an ordinary supply zone, right? But I can see price step into this. Okay, came down here. Okay, cool. Now we can draw our new order block right here, right? This is the pivot candle that led to this sharp and substantial downward movement that we have right here. Okay, so this is our new order block, and let's say we put our risk entry right there once again, right? We are entering for a sell at the edge of this zone. And then let's just see what price does. Does it actually go up there? Nope. I don't think it has went all the way up there. Okay, so let's just look for another order block. Okay, there's another order block right there. Okay, and then let's place our risk entry right there. Okay, let's just, once again, this is what you guys do, right? Risk entry. Boom, you are tapped into the trade right here. Nice. At this point of time, I will target the previous swing low. Once again, where is the previous swing low? Okay, so this will be the previous swing low. You always look towards the left, right? So this is the previous swing low. Target just right there. And then let's just see whether we hit take profit right there. Okay, it came down here. Okay, I believe we are going very near the take profit, right? Bam, you hit your take profit right there. Congratulations, you just won 2 trades out of, I don't know, 10. So as exciting as this risk entry are, sometimes they just don't really work, right? Because sometimes price can just tap into this order block and then just blow right past it and then just reverse and hit up and just go against you. In that case, you have lost this trade, right? So if you want to get a higher win rate, that is where you need to deploy what I call a confirmation entry. So unlike the risk entry, where you're entering straight away after price tap into your order block, on a confirmation entry, you are waiting for extra confirmation after price has stepped into the order block. And if you use this method, you will get a much higher win rate because you will actually be waiting for confirmation that shows you, that confirms to you that the order block is actually working and it's not just like a fake useless order block that price is just gonna blow right past it. Step 1 is to draw your order blocks, obviously. So over here, we saw that there was a sharp and substantial downward movement just like this. So in this case, we can actually draw our order block at a pivot candle, right? So for this right here is is a little bit weird, right? Because it's a very large area. So I just mark this entire area as my pivot candle right here, from the high to the low of this pivot candle. So now that we got our order block right here, right now we are just waiting for price to come back up here. Now, for confirmation entry, we are not going to be entering straight away when price step into the zone. We are going to be waiting for the structure to shift once price step into the zone, right, to get the extra confirmation. What I mean is that I want to see this little pullback to be over. Basically, right now, price has turned bullish to facilitate the pullback. So what I want to see on a 15-minute time frame is for this little bullish uptrend, this little pullback, to be over, right? So in that case, I need to look for some form of market shift, right? So let's just continue to look at price pulling back. All right, you can see price pull back and then finally tap into our order block that we have right here. So based on this, this was the last break of structure to the upside, right? Since this is the last break of structure to the upside, we know that this one right here is the lowest point that led to this break of structure, making this the last swing low. That means if price comes down there and break past this last swing low, that tells us that this pullback is over and right now price is turning bearish and is aligned with the higher time frame trend, and right now price is about to go down even further, right, to continue the bearish order flow. So in this case, like I said, this is what confirmation entry is all about. It's waiting for the extra confirmation that tell you that structure has shifted before you actually enter for a sell. So at this point of time, I'm still waiting because it has not given me a valid market shift yet, right? Like I said, if you are playing the risk entry, you would have gotten in right here. But in this case, we are looking for the confirmation entry. So I'm just waiting, still waiting until price broke structure. By the way, this is more for swing traders, okay? So yeah, right there, this is where we officially got a market shift right now, right? And this tells us that, cool, right now, this pullback is over. This bullish internal structure has officially shifted bearish, and the internal structure, the lower time frame trend, is aligned with the higher time frame trend, which is bearish. Now everything start to click like clockwork, baby. All right, so this is where you got a market shift right here. Okay, cool. Now, this is where we start looking for our entry. Now, to refine my entry, what I like to do is to look for more order blocks that is within the entry time frame, which in this case, since I'm entering the trade on a 15-minute time frame, I want to look for some form of order block within the 15-minute time frame itself. Right, so based on this, I can spot that, okay, there is a little order block right there. Okay, there's one order block right there. And then perhaps there's another one, I'll say right here, but this one has been mitigated, so it'll be this one right here. Okay, this one right here. Once again, sharp and substantial downward movement right here, guys. Let me just draw it out for you guys to see. Sharp and substantial downward movement. Sharp and substantial downward movement. And you can see this one right here, it also did lead to a break of structure. Okay, and there was a gap, so on and so forth. Pretty much fulfill all four criteria. So now, like I said, I don't actually know which zone price is gonna respect, so I'm just gonna wait and see, right? So okay, price eventually come up into this zone right here. Okay, there's a chance that at this zone is gonna go, okay, but we still wait for extra confirmation. Okay, you can see price actually ended up going even further, came all the way up here to our extreme order block that we have right here, and somewhere along the lines it just blow right past it. Okay, tap into this order block right here. So this one we can just completely get rid of. Now, at this point of time, this is where you can actually enter for a sell right here at the edge of this zone. And if you do actually enter for a sell right here at this order block, if you think about it, it's still some form of risk entry because you are still not waiting for the extra confirmation, right? So for it to be really a confirmation entry, in this case, I will go down to the lower time frame, the 5-minute time frame, and wait for this little pullback to be over, right? This bullish pullback once again to be over, and then that is when you can potentially get your confirmation entry in, right there, ladies and gents. You look at this internal structure on a 5-minute time frame. This is the last internal higher low. This is more for advanced traders already. We got the market shift to the downside, which tells us that right now price has officially shifted bearish, and that is where you can enter for your sell position right there. Okay, so you can enter for a sell right here, place your stop loss above this order block itself, and then like I said, you can take profit at the next structure or the next order block that we have right down here. Okay, so yeah, this is potentially what a confirmation entry is about. It's really waiting for the extra confirmation before you pull the trigger, right? If you want to even go like more extreme, right, more advanced, instead of entering right here, what you could have potentially done is to wait for price to pull back after this market shift into this area right here, right? This entire demand zone right there, and then you enter at the edge of this demand zone. And in this case, you can see this is a 1:6 risk to reward ratio trade, right? It's a very refined entry. Okay, but yeah, like I said, this is more advanced stuff, right? And right now, if you are a beginner, take things slow, right? Master the risk entry first, then go and master the confirmation entry, and then find out what works best for you. And then based on the data that you have collected, go and stick to that particular method, whether that is risk entry and confirmation entry. For myself, based on my own experience, I found that the confirmation entry just works so much better for me, because I found that when I use the risk entry, sometimes the order block just blow right past it, and I just take a bunch of losses that I would have taken if I just look, or rather wait for the confirmation in the first place. Now, to be honest, order blocks itself is powerful, but if you want to make it even more powerful, you need to combine it with liquidity concepts. And if you can combine these two concepts, it's like having X-ray vision on the market. You can actually see where smart money enter into the market and where they are most likely going to enter, and then you can kind of predict, and you can just do some witchcraft on the market. So if you want to learn more about liquidity concepts, you can watch this video right here. And as always, remember, you are just one trade away. I feel so weird.